Hi guys, Shelby Mathis here, and today we're going to go over four numbers that millionaires track every month and that you should be doing it as well. Where do I base this off of? I've been doing this for 28 years as a tax attorney. We do over 10,000 tax returns a year for investors, and so they can't lie to us. We actually see their numbers. We actually see their balance sheets. And what we see consistently, what I've learned over the years, over the decades, working with tens of thousands of investors, is that the most successful investors really focus on really four simple things. And I'm going to break it down for you. And then at the very end, I'm going to give you guys a special gift for sticking around. So let's go through this really quick. I'm going to break it into two broad categories. So there's four numbers we're going to pay attention to, but I am going to share a screen out here and we're going to break it down into two broad categories. Then we'll get into each of the four. Okay, let's do the two categories. The first one is cash flow. Cash flow basically is your income over your expenses. So the two categories that we're looking at here is your monthly income and your monthly expenses. And how to look at these, I would do your net income, money that actually goes into your bank account. Or goes into your retirement accounts, things like that. Like, what are you growing income wise that you could spend on a monthly basis that you get your hands on? And so it's going to be comprised of things like wages, which is your W-2. It's going to be things like your net rents. It's going to be dividends. It's going to be anything that you're bringing in. There's multiple types of income sources, your capital gains, whether it be from options or the sale of capital assets. It could be interest. It could be royalties. It could be any of these things. And what we want to know is how much is actually hitting an account that you have control over. So I'm not going to just say you're individual, because millionaires tend to have LLCs, 401ks, DB plans, IRAs, Roth 401ks, entities, other corporations. We're looking at what is coming in on a monthly basis, and we calculate that, and that gives us a very simple number. And then we look and say what's going out. And when I say expenses, I mean like your hard expenses, which might be things like, your rent or your mortgage, your living expenses, maybe your utilities, cable, your car, your auto expenses, including your gas, your food, your basic living necessities that are going out, plus your fun spending, your excess spending, and buying stuff. Like, you add it all up. If it's going on a credit card, it's still an expense. And the reason that they pay attention to this is because the difference between these, so you go income minus expense equals cash flow. And that tells me how much I have to invest. And this is the biggest mistake that is made of people as they're growing, is this expense sticks in line with that income. Especially like they get out of college, or, actually go back. You get out of high school and you have a certain lifestyle, and you go into college and you want to maintain that lifestyle. So you end up spending a lot, borrow a lot of money, do things so that you can continue to live like you were living. And sometimes you got to take a cut, right? Sometimes you got to live like a pauper for a little while, especially when you go into college and things. For those of us who are put ourselves through school, we had no other choice, but we had to do it. But you get used to living on an amount that was below what you were bringing in when you actually get a job and you start your profession. My recommendation is that expenses should equal 70% of your income, your net take-home pay. So whatever's coming in, live off of less, and that will create positive cash flow. What you do with that 30%, I have a simple rule. When I do the 70-30 rule, which is what I use, it's easy, back of napkin stuff. I look at what I'm bringing in, and then I want to live off of 70% of it. The other 30%, 10% is given away. I believe in giving to charity. I know some of you guys are not in a position where you have anything left. Like, maybe you're just really struggling, in which case I'd say give time. There's not, literally, I can think of hundreds of the most successful people I know, and all of them are voracious givers, and they were before they got successful. I have lots of clients that are self-made. I'm self-made, and I know that the people that I know in my business groups and things like that are self-made. They were always voracious givers. And so I would say 10% of your net take home, give it away. The other 10% pay down your debts. And I'll get there in a second because our next categories are going to include your debts. I'm not talking about your monthly minimum interest. I'm talking about additional amounts to pay down the debt and pay down the amount that you owe, especially high interest debt like credit cards. We want to attack those like they're trying to kill us because they will choke you out at some point if you don't get them under control. So you do that extra 10%, and then 10% goes into investing. And I don't care whether you're just putting it in the S&P 500 or like an index, or you're investing in stocks or whatever. I would start with something that's very liquid. And when I say liquid, it means that you can get to the cash quickly. If you're immediately going out and buying a house or a rental house or whatever it is, and that's your idea of an asset, I would caution you to be careful because those are hard to get rid of sometimes. Sometimes you can't, like 2008, 9, and 10, you had all these people that were house rich and cash poor, and they couldn't sell their house because everybody was in the same boat and they were all trying to sell their houses at the same time, and they couldn't. Market wouldn't bear it. So it drove those prices down in my neck of the woods 75%. So, people that had $1 million houses were selling them for 250. They were underwater. It was really, really ugly. That's not the situation right now. But even if I said, hey, I want to sell one of my houses quickly, it's going to be about a month on a good day before that thing's actually sold. So, and where I actually can spend the money. So liquid means things like ETFs, stocks, stuff that it's 3 days to get it. CDs I could get to if I needed to. Investments are just put in a savings account or not necessarily sitting there in banks, depending on how much you're putting away, but it might be a money market fund in a brokerage house or something like that, where you can turn it into cash quickly that you can spend. I like to keep my money when I'm first, building it up, at least a 6-month supply of cashola in the form of liquid assets. And I'll come back to that one in a second when we talk about this next category. So there's our income and our expenses. You can do very simple, look at what your average amount that goes into your accounts every month. You could grab that by just getting your statements and saying, all right, how much is going in? And let's add it up and average it out over the last year to get your income. If that's what you wanted to do, is you could just be, again, you could do this kind of in a crude factor. It doesn't have to be an exact science. And then you look at your expenses and say, what have I spent, including on your credit cards? And you look at those things and say, what's the ratio? And if you're at like 80%, 90%, then you're spending too much. You really either need to do one of two things: is you either lower the expenses or you increase the income. So a lot of folks that are struggling are sitting there going, man, my expenses are too high. I can't cut anything. I'm not going to tell you to cut anything. The best thing you could probably do is learn a side gig or how to make money on the side, whether it be in real estate, learning how to be a wholesaler, find things for people, or something to generate additional income. Maybe it's you and a spouse. Maybe you're starting a business, doing a side gig, whatever it is. Sometimes it's easier to increase that income than do the rice and beans and start cutting all your expenses, because there's only so much we can cut on expenses, whereas our income is literally an infinite number. Like we could create a ton of different income streams. And by the way, when you look at IRS data, the average millionaire, somebody who makes over $1 million a year, has an over 3 separate income streams. 1, 2, 3, 1, 2, 3, right? Usually it's between 3 and 6. And what's most interesting is their wages, and the wages in W-2 was about 36% on average of what they actually generated. So they were making more money off of the other income sources. And that's going to make sense in a second. Our next broad category is net worth. So we have our cash flow as a big category, and we have our net worth. And net worth is very simple. We have 2 categories. It's assets minus liabilities. Now, there we go. Assets minus liabilities equals net worth. Very simple calculation. Not my favorite, by the way, but most millionaires know these numbers. They know what their net worth is. They're going to say, what are my assets? And this could be, in theory, things like your house, your cars, your stuff, plus your investments, which could be your stocks, your rental real estate, your companies, that you own. Maybe you have some private stocks. Maybe you have some public stocks. It's anything that has value. Now, I change this up. And when I work with people, I look at things, I'm really looking at income sources that are being generated off of assets. So I have a simple rule that assets feed and liabilities bleed. So an asset to me is something that creates cash flow. So that kind of nixes your house and your cars and your stuff, right? I start looking at the things like maybe notes. I love those. I love private investments. I love real estate. I love the stock market. So I'm looking at those types of things. And what I count, I just look at different types of income or rents, royalties, things like from oil and gas, rents, royalties, dividends, interest, and capital gains. And not all capital gains. I use capital gains from the sale of options because they create this income stream. And those go up here, by the way. Those are all income sources. And so these start to interplay with each other. And you'll see that millionaires are really good at focusing in on assets that create more income so that they can continue to do what? Pay their expenses and buy more assets. Again, if we can increase that income, and we're living off of 70%, and we keep increasing our income and our income keeps going up, we're going to be spending more money on frivolity. Like we're going to be able to go get that really nice car and a really nice house, but you're also going to be able to continue to buy more assets. And that's what I always tell people is you don't want to be using your time, your wages, to be paying off things that you owe, your liabilities. And I'll go over those in a second. What you want to be doing is building up and using your income, the money, to buy assets. And then those assets, that income that's generated, could actually be paying for those liabilities. And your liabilities, to me, your liabilities can be something like a house. It can be your car. It can be your stuff, right? And so I shift them down. But I know that a bank is going to say, what do you have? And they're going to let you put stuff in the category of an asset, when in all reality, we don't use it. Like in the real world, when you're looking at investors, and here I'm going to draw this up fresh. When we look at investors, we have our income, our expenses, we have our assets, and we have our liabilities. When you're qualifying as something called an accredited investor, for example, to be able to do certain types of investments, you get qualified off of your income and the gross amount, not your net, but they're just looking at how much are you making. See, that actually looks like income. Or they look at your net worth, and your net worth, they do not let you use your house. You can't use your house. So they want to look at the assets. Generally speaking, there are actually investments where they require liquid net worth. Like they want to know how much, how many investments you actually have that have an easy disposable value, and they want over 5 million on some investments. They won't even let you invest unless you have that. And they're not looking at anything here or here. They're not looking at the amounts that you necessarily owe. They look at how much disposable asset you have. Really, it is your net worth. So they do factor in that liability. But a lot of times they're looking and saying it's not enough just to have assets. It's what type of assets. Do you have something that can be turned into cash? Because we don't want to be in a situation where you're having to sell your investment. A lot of these things, they're locked up for 4 or 5 years, and they don't want you to have to knock on the door saying, hey, I need some cash. Now, what are liabilities? I said liabilities bleed you. Those are things that you're paying to third parties. So those are all things like your loans. You have your mortgage on your house. A lot of times you have auto loans, you have stuff loans, you have credit card. When I say stuff, it's like going out and buying furniture on credit and things like that. It's money that you owe to somebody else. So when I look at it and I say, am I going to have to pay money on something on a monthly basis? Then I throw it into the liability category. And that's why I like to throw houses, RVs, cars. I say that's actually kind of a liability. And I know that some of you guys are going to go nuts. You're going to say, wait a second, my house is my biggest asset. Not in the investment world. It's actually considered a nothing. Like we don't even factor it in. We just look at it and say, hey, to the extent that it's worth more than your liabilities, that's great. To the extent the liabilities are worth more than your house, we're going to add that liability and we're going to factor it in, but you don't get the good. So they just kind of ignore it. The SEC actually removed it after the Great Recession because so many people got into trouble because they thought their house was an asset when it wasn't. So anyway, so you start seeing how this works. So let's have a nice clean sheet. I'm going to draw up the numbers that most people follow, and then I'm going to tell you what you can do to learn this, to actually start building it up. People that are using their income, they should be paying about 70% to cover their expenses. For lack of a better word, that 30% is going towards assets or giving it away. So we're paying that off, or some of it might go a little bit down here to pay down debt. So pay down debt, but there's 30% that's going over to that category. So your income, what's really magical, no matter who you are and how much you're making, is you could just sit there and say, as a general rule, I'm going to make sure that 30%, and it could be as simple as saying 10%, 10%, 10%. I'm giving away 10%. I'm putting that into a donor advised fund, or I'm earmarking it to go to charity or whatever. I'm taking 10% and immediately paying down any debts that I have, attacking my student loans or, credit card debt, especially being on 10% is going into my investment account, automatically being invested in certain things. That's beautiful. Then those assets come up here. And when you eventually have enough where it's covering 100% of your income, your assets are covering 100% of your expenses, then you're in that magic zone. I call it infinity. You could live an infinite number of days without selling anything because you have enough cash flow coming in off of the rents, royalties, dividends, interest, and capital gains. You have enough coming in, and I use options. So I say the capital gains that are coming in off of selling covered calls and things like that, which if you want to learn, all you have to do is go down in the comments and type free book, and I'll send you a free copy of Infinity Investing, How the Rich Get Richer and How You Can Do the Same. I wrote it. It got a Global Book Award gold medal years ago. I think I published it 4 or 5 years ago. I'll send you a free electronic copy. All you have to do is go down into the comments and type free book, and I'll send it to you. And it'll explain this and break it out for you, the philosophy as to why this is much, much better than sitting there trying to live off of this 4% withdrawal rate or whatever they're doing nowadays. I hate that stuff. I want to be able to live off of my money. I don't want to have to worry about my cash. I want to be able to, here, I'm just messing with my ink so I can actually draw. There we go. I don't want to worry about selling off my assets. So if I have 100% money coming in, cash flow that covers my expenses, and I never have to worry about W-2 ever again, then it's gravy. If I work, it goes straight into my assets. I'm just continuing to build my asset base. That's why you have wealthy people that sometimes keep working into their 80s, 90s, because they love it. Plus, they know that they're building this huge legacy builder. These assets don't go away. Even after you die, they continue to generate income. So you could create, a legacy for your kids, your kids' kids, your kids' kids, kids' kids, right? You could create something that doesn't go away. Hence, we call it infinity investing. These liabilities here, we've already paid them down. Most people, by the time they're in this situation, they might be levering certain assets, but the asset is paying for the liability. What's not happening is you over here, you're not having to pay for the liability. That's a big no. You're no longer paying money towards liabilities. And you're saying, well, wait a second. My assets are still doing it. Maybe it's my rental property paying for a loan on it, or maybe I have an apartment building and it's paying for that loan. That's okay, because the tenants are paying for that liability, not you. You're not having to go out and get work 40 hours a week to pay that liability. If you can get this down, if you can get these concepts down, I've seen it time and time again. And there's different versions. Like there's lots of people out there that are talking about living below your means because it doesn't change. You want to be successful. You want to be a millionaire. You want to be wealthy. It doesn't matter what profession you're in. In fact, Dave Ramsey and Steve Hogan, I believe, did this big study of over 10,000 millionaires. And the third category, the top one was engineers, second was accountants, and third was teachers, school teachers in the United States were millionaires at a greater clip than doctors and stuff. Why? Because they lived below their means by having a 401k or something that was automatically investing, and they always did it. So just by the fact, the way they structured their life, they were automatically doing this thing where they were building up this asset over 20, 30 years, and magically with compound interest, they end up with this big pile of cash when they're said and done. It works like a charm. If you can live below your means, in other words, your expenses are below your income, and you invest the rest, you're going to be very, very successful over the long run. The numbers are all in your favor. Compounding works like a charm if you give it long enough time. I'd say 15 years is kind of that magic target line where there's 0 instances when we back test. If you invested in the stock market, for example, and just did like big indexes, there's not a single case after that 15-year mark where they were negative. They're almost like every study I've seen shows that you're in the positive, and you're making on average, it's about 10% historical. So there's no guarantees, but you could pretty much look at that and say, hey, I'm putting all the odds really in my favor. It's like being the casino instead of the gambler. I'd rather be the casino. The odds are in my favor in all things, numbers, the way they work. If I give it a long enough period of time, I'm going to have a lot of success. Now, if you're older, it doesn't mean that you throw all this out and you say it doesn't work for me. It just means that you have a little bit of catching up to do, and you could certainly do it. And especially this number might need to come down a little bit and say, hey, my expenses, maybe they need to be a little lower if I really want to push money aside. But if you learn to do this, you're going to get great results. Guys, let me know what you think in your comments. What's your favorite type of investment strategy that you would put in here? What type of assets you love the most? Put it in the comments. If you can, like and subscribe. And if you know anybody that would benefit from this, please share it. And remember, all you got to do is put free book down below, and I'll send you a link to a free electronic version of Infinity Investing, How the Rich Get Richer, and you can do the same. Good luck.